If there's one sector that's been in the limelight, it has to be the financial space. Unfortunately, most of the news flow has been negative for the sector, be it the liquidity crisis or the piling up of NPAs. That also makes it interesting for the analysts tracking the sector. Joining us now from the sidelines of the GM Financial India Conference is Sameer Bhise, their banking research analyst. Sameer, hi. So I want to start with the news that has come in today morning. There's been a downgrade to the Indian economy by Moody's. So in this backdrop, how do you expect it to pan out for the financial services sector? Because things have already been difficult. So you think that the revival from here on for some of the beleaguered entities in the sector, it's going to be even more difficult?
Yeah, hi, thanks. Over the last couple of quarters, we have seen a perceptible slowdown in overall growth. To that extent, we believe that while earlier part of this year, there were expectations that we are probably at the peak of possible stress in the system. Last two quarters have kind of falsified that belief. We still think that some bit of stress will come through over the next couple of quarters, or maybe 3 quarters, specifically some of the NBFC names which continue to hog the limelight. And there are incremental worries from some of the newer sectors, for example, telecom, which will be closely watched out. We see there will be inch up in sector NPLs over the next couple of quarters. In this environment, we continue to stay with the larger names. Given that overall growth environment is slightly tepid, larger names have a relatively better balance sheet to support some of these risks which may come through in the next 2 quarters.
Okay, so if we have to detail
as a sector, we continue to
please go ahead.
Yeah, please.
No, you please continue with your point.
As a sector, we see that as a sector, we continue to see that material outperformance is slightly unlikely in our view. The sector may remain more sideways over the next 2 to 3 quarters until some of these headwinds subside and growth improvement is seen. So to that extent, while we have seen recent pullback from the lows which we had seen in earlier part of September, but overall we see the sector to remaining sideways.
Okay, so if we have to detail it out in terms of how is it going to be for banks in terms of business momentum, purely the lending and the deposits, how that is expected to pick up or happen in the quarters to come, and you put out a detailed report on where the deposits are going to come from. So what is your thought process on the same?
Yeah, so if you see at overall credit growth in the system has slowed down sharply. In fact, the latest print is close to single digits, around 8 to 9%. To that extent, there are hopes from some uptick which may come through due to the festive season. Does it change the overall broad picture? We still are a bit unsure. Perceptible slowdown in retail, specifically driven by some of the sectors such as auto, also housing to a certain extent. We see credit will remain sluggish. Recent tax cuts by government, if at all, if they translate into some bit of corporate investment demand picking up, it's still around 18 months in our view. So near term, we have an environment of slowdown in overall credit demand, and in addition to that, some bit of new stress which will flow through bank P&Ls is what we are seeing. At the same time, as a sector, we have seen that from a investor positioning point of view, money has flowed away from NBFCs into insurance and some of the select asset management companies which have delivered on numbers, and growth momentum there still remains healthy. In addition, both these businesses do not have issues of asset quality. So to that extent, we have seen significant re-rating. We continue to like large banks and both these spaces from a positioning perspective.
Okay, so going forward, how do you expect the asset quality to pan out, especially when Moody's is pointing out that the credit crunch may actually worsen from here on, and especially one part of it is the big corporates, the crunch there or the difficulties that some of the big corporates are facing, but the credit flow to the small and the medium enterprises has also been sluggish. So do you expect the asset quality issues to continue for next few quarters from here on and reflect in the books of banks, in form of NPAs, higher slippages, etc.?
Yeah. So what the last 12 months, specifically after ILFS, have indicated is that there is a sharp wedge which has been created between the top-notch corporates and the not-so-great names. So to that extent, borrowing costs for the larger names have come off substantially, while for those who are even a bit less on quality or risks, the cost of borrowing there continues to be elevated. Whether this and in addition to that, GDP growth has slowed down. So I think overall, as a sector, we are seeing some inch up in the slightly double B and below kind of pools from a asset quality perspective. Our sense is system NPLs are in high single digits. There is a reasonable chance that they may inch up to early double digits over the next 2 quarters, and probably adding around 75,000 crore to 1.5 trillion in additional GNPLs for the sector, which roughly translates into 75 to 150 basis points on the overall sector over the next 2 to 3 quarters. From a provisioning perspective, however, we are much better than what was the case around 2 years back, because banks have taken significant provisions on the existing stock of assets, and incrementally also there has been a significant conservatism from a provisioning perspective for some of the large banks. So to that extent, while there was earlier an expectation that credit costs may dip sharply, we see that credit costs will remain high. But is there a case that credit costs go back to what we had seen in 2016-17 levels? We still think it is unlikely.
Okay, so Sameer, when I look at the coverage that you have of various stocks in this sector, you have a buy rating on most and a hold rating on some of the stocks which are in a difficult spot right now. For instance, RBL Bank, Yes Bank, etc. And for rest of the stocks, on majority of the stocks, you have a buy rating. So is that a valuation argument coming here? Is it that due to cheap valuations, you are giving out buy recommendations to your clients?
So the larger names, as I said, we continue to like, which is why some of the larger names we have rated as buy. In addition to that, so our hold rating is primarily driven by how we see valuation vis-a-vis the fundamentals moving. I would not want to comment on specific names at this point in time, but a clear preference towards the larger names from that is what we are thinking.
Sameer, on one hand, we have these cautious commentaries coming in, and obviously, you're also expecting the pain to continue in terms of the asset quality. But for some of these banks, there are fundraising exercises happening and a very strong effort going on to be able to get in those funds. And aside of the financial services sector, some of the corporates which are under stress are also trying to resolve their stress. For example, Z being a case in point. So you think that all these activities may actually come in as a savior for some of these stocks, and hence we may see a revival coming in?
So let us look at overall how resolutions have panned out over the last couple of years. I mean, some of the top 12 NCLT cases still remain unresolved. So to that extent, versus earlier hopes of a swift resolution between 180 to 270 days, some resolutions have actually dragged on for almost 2+ years. So to that extent, this time, as investors and analysts, I think we are a bit more cautious on resolutions, and would actually see proof of the pudding before actually getting positive on some of these. Obviously, if capital raisings happen, if resolutions happen, that's positive. But at this point in time, is there significant comfort that we go ahead and look beyond these risks? I don't think so.
Sameer, when it comes to NBFCs, the verdict in last 1 year has been very clear. The verdict given by the stock price performance, and that is getting reflected in the valuations as well. Clearly, the housing finance companies have underperformed, most of them barring an HDFC, and the strong outperformers have been the micro lenders and the gold finance companies. Is that how it is expected to continue in next 1 year as well?
So obviously NBFCs have multiple asset classes and each of them specializes. To that extent, the performance of individual stocks is driven by how underlying asset classes are moving. We have seen significant stress in auto, we have seen stress in real estate. So to that extent, it has manifested on HFC's performance. We continue to like large consumption oriented NBFCs, and there is a specific preference from our side on high quality names, where we think these names will benefit both from increasing market share, because the number 2, number 3, number 5 player is facing liquidity issues. At the same time, there is a disproportionate benefit that larger guys will derive from lower funding costs. So while on one hand we say that overall banking system is slightly conservative when it comes to lending to NBFCs, we have also seen that some of the larger names are getting a disproportionate benefit because of the quality that they have. So we have a clear preference towards them, and one of the names obviously which you mentioned continues to be among our preferred names.
Sameer, just one last question for viewers watching this and for your clients as well. Which are your top bets at the moment? You mentioned you like large banks, and at the moment there's been a clear divergence towards insurance companies and AMCs as well. So would you like to spell out some of the names here? Which are your top picks right now?
Obviously we won't want to comment on specific stocks, but we have liked some of the top 3 names in the Indian banking sector. That continues to be our preferred list, and that is how I would like to put it at this point in time.
All right, Sameer, thank you so much for joining us, and all the best for rest of the conference.
Thank you.